How to get a home loan with low interest. Getting a home loan with a low interest rate can save you thousands of dollars over the life of your mortgage, but the lowest advertised rate is not always the cheapest loan. Your credit profile, income, existing debts, down payment, loan term, loan type, fees, and the lender you choose can all affect the rate and total cost. The smartest approach is to prepare your finances first, compare multiple lenders, and evaluate the complete cost of each loan, rather than focusing only on the interest rate. First, improve your credit profile before applying. Lenders generally offer more favorable mortgage pricing to borrowers with stronger credit. Before applying, review your credit report for errors, pay every bill on time, reduce high interest debt, and avoid taking on unnecessary new loans or credit cards. Also, avoid making major financial changes immediately before closing. A change in your credit score, income documentation, loan amount, or other application details can affect the final terms, even after a rate has been locked. Next, save for a larger down payment if it makes financial sense for you. A larger down payment can reduce the amount you need to borrow and may improve your loan options. However, don't drain your entire savings just to increase the down payment. You should still have money available for closing costs, moving expenses, emergencies, and unexpected home repairs. The ideal amount depends on the loan program, your finances, and the housing market where you live. Then, compare several lenders instead of accepting the first offer. This is one of the most effective ways to find a competitive mortgage. Compare banks, credit unions, mortgage companies, and other legitimate lenders. The CFPB recommends getting at least 3 offers so you can compare rates and costs and use competing offers when negotiating. When comparing lenders, request the same type of loan, the same loan amount, similar term, and similar down payment, so you are making a genuine apples-to-apples comparison. Don't look at the interest rate alone, compare the total cost. A loan advertising a lower rate could have higher fees, points, mortgage insurance, or other charges. Look at the annual percentage rate where applicable, upfront costs, monthly payment, total interest, and other fees. In the US, the standardized loan estimate makes it easier to compare mortgage offers from different lenders. A good loan is not necessarily the one with the lowest headline rate, it is the one that provides the best overall cost for your situation. Consider whether paying discount points is worthwhile. Points are upfront payments that can reduce your interest rate. They can make sense if you have enough cash available and expect to keep the mortgage for a long time. But paying points is not automatically a good deal. Ask the lender to show you the loan with and without points, and compare the upfront cost against the monthly savings and the amount of time you expect to keep the loan. Choose the loan term carefully. A shorter mortgage term can sometimes come with a lower interest rate and can substantially reduce the total interest you pay, but the monthly payment will generally be higher. A longer term can make monthly payments more affordable, but usually results in more interest paid over time. Choose a payment that comfortably fits your budget, rather than stretching yourself simply to qualify for a larger home. Don't forget to negotiate. Once you have multiple offers, go back to your preferred lender and ask whether they can match or improve a competitor's rate or reduce certain fees. Multiple offers give you bargaining power. Just make sure a lender isn't lowering one fee while quietly increasing another. Compare the complete loan costs before deciding. Finally, understand the interest rate lock before closing. Mortgage rates can change, sometimes frequently. A rate lock can protect you from an increase during a specified period, but it may have conditions or costs, and you could miss out on a lower rate if market rates fall. Ask how long the lock lasts, what happens if closing is delayed, whether extending the lock costs money, and whether the lender offers any option if rates fall before closing. The bottom line is simple. Prepare your credit, control your debts, save an appropriate down payment, compare at least 3 lenders, negotiate the complete loan package, and calculate the long-term cost before signing. And remember, the best mortgage is not necessarily the loan with the lowest advertised interest rate. It is the loan whose total cost, monthly payment, terms, and risks fit your financial situation. Mortgage programs and regulations vary by country, so always verify the specific rules and offers available in your local market before making a decision.